Investing is not about the assets you choose, the time you invest, the amount, or the tax that you save. It's about your behavior as an investor. And today, I want to give you 5 investing truths to memorize and to live by if you want to succeed. Hi folks, and welcome back to the channel. I came across a brilliant infographic the other day on the absolutely superb Visualcapitalist website. I just love that site. I'll put a link to it in the description so that you can check it out for yourself. But this infographic has 5 quotes that should be understood by all investors, and I loved it so much I thought I'll just make a video about that. So let's get right on to quote number 1. The most important quality for an investor is temperament, not intellect. This is from the CEO of Berkshire Hathaway, Warren Buffett, arguably the greatest investor that's ever lived. And it's encouraging, right? We haven't got to be smart to invest effectively. We just need to know how to handle ourselves. It means, and I agree with this, that the technical makeup of our investments is less of a factor in our success than our behavior towards those investments. In practice, that means not tinkering with our portfolios in volatile markets. It means not worrying about the inevitable ups and downs that our portfolios will experience. That's just the price of investing. It also means that anybody can do this as long as they cultivate a healthy attitude towards money in general and their portfolios in particular. On to quote number 2. The individual investor should act consistently as an investor and not as a speculator. This is from Benjamin Graham, who wrote the seminal work on investing called The Intelligent Investor. And Graham's work was a huge influence on Warren Buffett, who we heard from just now. So what is the difference between a speculator and an investor? Well, a speculator is essentially betting. They're usually all in on one winner takes all, loser takes none option. If you're all in on crypto right now, you are speculating, not investing. I'm not saying that's a bad thing, it's your life, but it is a fact. An investor, by contrast, builds for the future. They use the time-tested facts of compounding, reinvesting dividends, owning the great businesses of the world to build wealth over long periods of time. They are patient, not petulant. They understand how money works. They don't do the lottery or pin their hopes on an inheritance one day. They build one brick on top of another, investing monthly for 30 or 40 years to build something incredibly resilient. By the way, if you're enjoying these so far, don't forget to hit the like button. Subscribe to the channel if you're not already. It really helps the channel to grow, so thank you in advance for that. On to quote number 3. The biggest risk of all is not taking one. This is from Melody Hobson, who is the co-CEO of Ariel Investments and also the chairwoman of Starbucks. Risk is a word that most people are rightly wary of. Nobody wants to take an unnecessary risk. I wouldn't carry a sack full of cash walking through a dodgy area to get to the bank. I'd be dropped off right outside the door. But we know that risk is an essential part of building wealth. Some might think that taking no risk by leaving our money safely in the bank, for example, is better than risking it on investments. But that actually isn't a risk-free option at all. We are experiencing inflation risk for a start, the risk that the buying power of our money will be less in future than it is now. And so we need to understand that risk is multifaceted. It really isn't just about the risk of markets and our investments going down. That, as we said, is a known outcome. It's not a risk at all. It's going to happen. Fortune favors the brave, who dares wins and all that. Risk can be understood and it can be quantified so that we know what risks we are taking. Better that, certainly, than erring towards what we think is safe and then losing money by stealth to inflation. Here's quote number 4. Time in the market beats timing the market. This is from Ken Fisher, founder of Fisher Investments, whose adverts you can find in literally every corner of the internet. But it actually might be one of the most often quoted lines I've ever used, because it's just so true. The message here is that you can't possibly know what the trajectory of markets will be, whether they will go up or down. History shows us that given enough time, markets will always rise. So the key is to hold on for the long term and not try and beat the market by moving in and out at what we think might be good times. So the market tanks. You hold on for a while and then eventually you sell out. You've had enough. You don't want to take any more losses. You tell yourself that you will reinvest when things are looking better. The problem is that this requires you to get two decisions right. One when to get out, and the other when to get back in. And the odds are that in the process, you will miss the best days of bouncing markets. There's a great stat that says that if you invested in the S&P 500 index in the US in 1930 and stayed invested for 90 years to 2020, you would have a return of 17,715% on your money. But if you missed just the 10 best days in the market in each decade, your total return would have dropped to just 28%. Missing the best 90 days out of 90 years meant giving up 99.85% of your return. And we can't know when those really great days will be. So we shouldn't try and time the market. We should just hang in there for the long haul. And finally, quote number 5. It's better to be roughly right than precisely wrong. Finally, this is a quote from the so-called father of modern macroeconomics, John Maynard Keynes. And this speaks to the importance of spreading your money around. If you choose 5 stocks to buy, they had better be the right ones. If not, you're going to be regretting your life choices. But if you buy 5,000 stocks, perhaps through a tracker fund, then some of those stocks will fail. You will have been wrong about some of them. But you'll have more right than wrong stocks, and you will make money over time. For me, this is another argument in favor of passive over active investing, at least at the core of our portfolios. We know that some companies will fail and others will fly, but we can't possibly identify which those will be. But if we hold them all, then the winners should outnumber the losers, and we'll do all right over time. So there we have it, 5 quotes to live by as investors. Have you got a favorite? Let me know in the comments and tell me why that one is your favorite. What's that? What's my favorite? Well, for me, it has to be number 1 by Warren Buffett. The most important quality for an investor is temperament, not intellect. I find that super encouraging. Okay, folks, I hope it was helpful. If it was, please give the video a like for the algorithm. Subscribe to the channel if you haven't already. It really helps. So thank you so much, and I'll see you in the next video.